Hello, I'm David Frazier, the founder of Investors Monitor and the president and chief market strategist of Frazier and Mayer Research, LLC, our independent investment research firm. This is the first in a series of new videos that we plan to record every week during 2018 on individual stocks. And we're recording today's video on Tuesday, January 16th. The types of stocks that I'll generally cover are are stocks of companies that either currently meet or appear to be on the verge of meeting our stringent investment selection criteria. So before getting into this week's stock, let me speak briefly about what is our primary criteria. Well, first of all, we look for stocks of companies that are either offering revolutionary new products and or services, or that are leaders in their field and are dominant leaders in their field. We don't like to see a lot of competition. We like to see little competition. That should be very obvious. If a company provides a product or service that is in big demand or growing demand, and there's little competition, well, that company is probably going to grow its revenues and earnings at a very fast pace, and its stock price is probably going to move up sharply during a short period of time. So that's the next thing we look for: revenues and earnings, growth in revenues and earnings, rapid growth of revenues and earnings. We don't want to just assume that a stock is offering a revolutionary product or service, or that it's a leader in its field. We want to see that company prove that it's a leader and prove that it's either a leader or has a revolutionary product and service. And if the company's revenues and earnings are growing at a fast rate, or have been over at least the past few quarters, and there's a good indication that it's going to continue to grow its revenues and earnings at a fast pace, well, the company's stock's probably going to do very, very well. Next, we look for companies that are strong financially, stocks of companies that are able to pay their bills on time and that are able to sustain a downturn in the overall economy or economies around the world. You know, in the event that a particular country in which the company operates, or countries in which the company operates, were to go into a recession, well, we want the company to be able to withstand that recession and to be one of the early companies to bounce back and have better days once the economy turns up again. Next, we look for, very importantly, doesn't always work out. It's difficult to find the next one, a variable, that is to meet that variable. But we look for stocks of companies that institutional investors have recently owned a very small percentage of the company stock, but they've recently been buying an increasing number of shares of the company stock and an increasing percentage of the company stock. And the reason should be pretty easy to figure out. I mean, if an institutional investor or institutional investors own a relatively low number of a company's stock, or a low percentage of the stock, but then they start to increase their ownership rapidly and start to buy a larger and larger number of shares, well, that stock price is probably going to move up quickly. And the reason being is institutional investors, not individuals, tend to determine the direction of stock prices. And that's because they buy in such large quantities. So when that demand picks up for the company stock relative to a short period of time, a fairly constant supply of stock, and the demand goes up, well, the stock price is probably going to move higher. And lastly, we try to find companies, and we prefer to find companies to invest in ourselves and to recommend to our clients and subscribers, stocks of companies that appear to be selling at low valuations. That is, their projected earnings and or the value of their assets seem to be selling at a low, the stock price appears to be selling at a low price. The stock price seems to be at a level that's low relative to the company's projected earnings and the value of its assets. And there's two reasons for that. One is if you're lucky enough to find a stock of a company that has a revolutionary product and or service, or that it's a leader in its field, that is strong financially, that institutional investors have begun to increase their percentage ownership substantially, and that it's trading currently at a low valuation relative to its future earnings prospects, well, the downside risk, the risk of you losing money on that stock is very, very minimal. And also at the same time, once an increasing number of investors, speculators, and traders realize that the stock is selling at a low valuation, well, they're probably going to come in and start buying it in droves. So, having said that's our overall investment criteria. It's really more detailed than that, but those are the primary criteria. So, now I'm going to discuss this week's stock, and that's Cleveland Cliffs. Cleveland Cliffs, symbol CLF. Cleveland Cliffs is the United States' largest producer of iron ore. Iron ore is a key component of steel making. Cleveland Cliffs, by the way, has been in business since the year 1847. So it's obviously been around a really, really long time. And so what attracts us to this company, other than what I just stated? Well, for one thing that attracts us is the overall macroeconomic environment. Economies in major regions of the world have been improving substantially, or did improve substantially, over the past approximately 18 months. And economic indicators from around the globe suggest that major economies are going to continue to improve, and that the pace of economic growth in major economies, including the United States, the Eurozone, Japan, Brazil, China, and India, are going to, the pace of economic growth in those countries is going to increase, continue to increase during at least the first half of 2018. And what does that mean for Cleveland Cliffs? Well, it's very simple, isn't it? I mean, if economic conditions are improving in major developed and or developing regions of the world, well, it's a very, very good chance that both governments and businesses and individuals in those countries and regions are building new office complexes, are building or buying more homes that are being built. There's more physical complexes, homes and office complexes, industrial complexes are likely being built during those improving economic situations. And individuals and businesses are probably buying more automobiles. Governments are improving and building more bridges. So what does that mean? Well, it's pretty simple, isn't it? Steel is used in all of those products or those goods, office complexes, homes, automobiles, bridges. And Cleveland Cliffs, well, if it's the #1 producer of iron ore in the United States, a key component in steel making, well, the demand for that company's iron ore is probably going to continue to increase in a way similar that it did over the past few quarters. And what I mean by that is Cleveland Cliffs revenues and earnings increased rapidly over the past few quarters. And yet the company's stock appears to be trading at a very low valuation. So Cleveland Cliffs it's a leader in its field. It therefore has very little competition. It's been increasing its sales and earnings at a rapid rate. It looks like it's going to continue to do so over at least the next 18 months. The financial condition is a little bit of concern. The company has a lot of debt, but it's often difficult to find a company that meets all of one's criteria, and it's trading at a low valuation. So having said that, we expect this stock, or we think it has a very good chance of doubling in price over the next 12 months. And it's already up 20% just in the past 2 weeks. Now, having said that, that doesn't mean I'm suggesting or recommend that you go out and buy it tomorrow on Wednesday, January the 17th. It's really important to get into these types of stock at the right time, at the most favorable reward to risk ratio. And the reason being is these types of stocks often are very, very volatile. And you might buy a stock such as Cleveland Cliffs that the long-term outlook is very positive, but you buy it at the wrong price, and all of a sudden it's down 10, 15% in a few days, and you're thinking, wow, I got to get out of this. So, we want you to get in at the right price. It's very, very important that you buy it at the most favorable reward to risk time and price. And so if you'd like to know when we think those times are or will be both to buy and sell the stock, I encourage you to try either our Frazier Strategic Allocator Investment Journal or our Frazier's Exponential Growth Opportunities Investment Journal. And our prices are very competitive. You can go directly to our website once you finish watching this video, in the description box area underneath the video. If you scroll through that towards the bottom, you will see a link that will take you to the subscription page of our website. And you can try out either of those services for the next 3 months. One of them is only $79, and the other one is only $99 for the next 3 months. So I thank you for watching and listening. I hope you got something out of this, and we'll speak with you on another stock this coming weekend.